Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Of a chart, but conceptually I think you'll get where I'm going with this. This is a chart of SPY, IWM, and MDY. This is the small cap. This is the SPY, which is the ETF that tracks the S&P 500, IWM, which tracks the Russell 2000, and MDY, which tracks, the mid cap. So with that, just from looking at this chart, I think it's pretty obvious to see that all three of them move very similar to one another. So when people say, oh, I have a real well-diversified portfolio, I'm X% in large cap, X% in mid cap, X% in small cap. Yeah, that's fine, but to me, as I look at that, it kind of moves the same way. Now, I know there's statistics out there that say over certain periods of time, small caps have outperformed, and during other points in time, large caps outperform. But over time, if you're going to sit in this for 30 years, if you have the statistics to back it, okay, but to me, in terms of diversification, this is just a very small, minute level of diversification, having different sizes of the portfolio within your account. Now, let's say that you diversify in another way. You diversify through sectors. Okay, well, here you're getting a little bit more diversification. These are the 9 Spider Select ETFs, XLE, XLB, XLI, XLU, all we kindly refer to these as the SCLA ETFs, so to speak. These represent the different sectors, the energy sector, the industrial sector, the healthcare sector, and so on down the line. Now, you're seeing a little bit of difference in these. So with that, I typically tend to prefer diversifying based upon sector as opposed to size of the stocks. But still, even as you look at these, the old saying, a sinking tide lowers all boats and a rising tide raises all boats, it definitely has the ability to apply to these. Now, we have portfolios with which we diversify based upon sectors, but within those portfolios, we're looking to do various option skews on them for the long term. So with that, or I shouldn't say option skews, but we're looking to open up the door to potential option opportunities within the long-term portfolio. So with that being said, are you extremely diversified with this? I don't think so. Now let's look at the overseas markets. Let's compare Japan, Britain, and the U.S. This is the Japan Stock Index, an ETF of the Japan Stock Index, the U.K., as well as the S&P 500. You can see there it also moves in the same direction. But now, where do currencies fall into the role? We believe for many investors, currency exposure in the long-term portfolio is something that can be of benefit. The straddle and the strangle are the strategies today. So with that being said, we're going to do this more as the mentality of what we're using today has more to do with shorter-term trading. And right now, currencies for the long term, I think it's still a very valid part of your portfolio. However, right now the trader in me is just too excited to keep the mentality on the long term, so to speak, because there's just so much going on in the short-term market. Straddle and the strangle are what we're going to discuss today. Now, let's start out with the long straddle. And we have a question, what software are you using to show these comparisons? I use I believe it was the brokersXpress platform. Just got some screenshots on there, just did some comparisons of it. The long straddle. Long straddle is when a call and a put are bought on the same underlying at the same expiration, meaning XYZ stock is at 50, and we're going to buy the 50 call and the 50 put simultaneously. With that being said, it's a limited risk trade. We're buying a call and we're buying a put. And our hope is that we get a lot of movement, one way or another. So, with that being said, we're hoping to make a lot of money on the call and let the put expire worthless, or a lot of money on the put and let the call expire worthless. We just don't know which way it's going to be. So with that being said, oftentimes I've heard people say, well, it's a great trade. You can make money if the market goes up or if the market goes down. Well, like I said, that's kind of I refer to that as a half-truth. And my pastor at church always used to say a half-truth is a whole lie. So what I want to do is tell you the full story of the straddle as we do this today. So once again, money can be made to the upside or to the downside. We just don't know which way it's going to be on there. Now, the other trade with which we're going to discuss today is the long strangle. The long strangle is kind of a different animal than the long straddle. So with that being said, instead of buying an at-the-money call and put, like what we're doing here, to where you can see in the risk-reward profile how we kind of have the V going, so to speak, long strangle, we have more of a flattened bottom. So in this case, this is just an older example from an older chart on YUK. You can see that we're buying the 95 call and buying the 88 put when the underlying's trading at 91. We're buying an out-of-the-money call and an out-of-the-money put at the same time. And our hope is that the market will go a long ways in either direction. We just don't know which direction. Same concept as the long straddle. It's just going to cost less money. So why would you consider doing a straddle over a strangle? Or why would you consider doing a strangle over a straddle? The advantage of the strangle, it's going to be less overall risk. So if the market stays the exact same, you're going to lose less money on the long strangle. However, the disadvantage is that it's less likely to profit. On the straddle, I want you to look at that bottom point on the actual graph in the upper right-hand corner. If it just moves a little bit, you start to make money. On the strangle, you have a bigger flat point with which you need the market to move for you to start making money. So, with that being said, let's go through some of the myths of both the long straddle and the long strangle. First off, you have an enemy. When you buy a stock, whether you're buying an ETF, a stock, whatever the case may be, if you're long, you have enemies. And the key to trading is to know your enemy, so to speak. If you're long, your enemy is the bears. So that means if you're bullish on a stock, your enemy is the bears. If the stock goes down, that's the problem to you. If you're short a stock, your enemy is the bulls. If the stock goes up, that is your enemy. So on the long straddle and the long strangle, understand you also have enemies. Bulls and bears are your friends with this. The enemy is non-movement. So if that stock or that currency option or that underlying currency stays within that range or it just doesn't move at all, that's your enemy. And not only do you lose money on the call expiring worthless, but you'll also lose money on the put expiring worthless. You're taking on double premium risk when doing this trade. So, once again, you have enemies. The other thing that needs to be mentioned is that if you're buying an option, you're taking on the risk of premium. If the option expires worthless, you lose. And in this case, you're taking on twice the premium risk than you would of just buying or picking a side. So on that note, well, I don't want to take on double premium risk. I'm an option seller. I'd rather just sell premium because I like to have time decay working in my favor. After all, what are the three things that we're sure of in life? Death, taxes, and time decay. Let's go short.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.